The global financial system is entering a transition phase unlike anything seen before. For the first time in modern history, money itself is being redesigned in multiple competing forms at the same time. Central banks, private companies, and blockchain networks are all building different versions of digital value, each with its own vision for the future. At the center of this shift are three concepts that are often confused but fundamentally different: central bank digital currencies, stablecoins, and tokenized assets. Understanding which of these will dominate the future requires more than hype or headlines. It requires understanding what each system is designed to do, who controls it, and what problems it actually solves. What CBDCs really are, central bank digital currencies, or CBDCs, are digital versions of national currencies issued and controlled directly by central banks. Unlike cryptocurrencies, CBDCs are fully centralized. They are designed to function as legal tender, backed by the full authority of a government. The primary goal of CBDCs is not innovation, but control and efficiency. Governments want faster payments, better tracking of money flows, improved tax collection, and more direct monetary policy tools. A CBDC allows a central bank to move money instantly, monitor transactions in real time, and even program how money can be used. From a state perspective, CBDCs are powerful. From a user perspective, they are familiar. They feel like digital cash, but with far less privacy than physical money. CBDCs are not meant to replace banks overnight, but to modernize the existing system while keeping control firmly in government hands. The role of stablecoins. Stablecoins are privately issued digital currencies designed to maintain a stable value, usually pegged to a fiat currency like the US dollar. Unlike CBDCs, stablecoins operate on public blockchains and are typically issued by companies rather than governments. Stablecoins solve a different problem. They provide a fast, global, internet-native form of money that can move 24/7 without relying on traditional banking infrastructure. This makes them extremely useful for trading, remittances, and on-chain financial applications. However, stablecoins come with trade-offs. They rely on trust in the issuer, transparency of reserves, and regulatory compliance. While they are more flexible and open than CBDCs, they are also more vulnerable to regulation, bans, or mismanagement. Stablecoins sit in a middle ground, more open than state money, but more centralized than decentralized cryptocurrencies. Tokenized assets change the question entirely. Tokenized assets represent a fundamentally different layer of the financial system. Instead of focusing on money, tokenization focuses on ownership. Tokenized assets are real-world assets, such as bonds, real estate, equities, or funds, represented as digital tokens on a blockchain. This approach transforms how assets are issued, traded, and settled. Ownership becomes instant, fractional, and programmable. Assets that once required intermediaries, paperwork, and long settlement times can move seamlessly across global networks. Tokenization does not replace money. It changes how money interacts with assets. Whether payments are made using CBDCs or stablecoins, tokenized assets define what is being bought, sold, and owned. In many ways, tokenization is not competing with CBDCs or stablecoins. It is building the environment in which they operate. Control versus flexibility versus ownership. The real difference between these systems lies in who holds power. CBDCs prioritize state control and policy enforcement. Stablecoins prioritize speed, accessibility, and global reach. Tokenized assets prioritize efficiency, liquidity, and modern ownership structures. Governments are likely to push CBDCs for domestic payments and monetary policy. Private markets will continue using stablecoins for global transactions and on-chain finance. Meanwhile, institutions are quietly adopting tokenized assets because they improve market efficiency without changing the nature of money itself. These systems are not mutually exclusive. They are layers. Interoperability and integration. New point. The biggest question for the future is not which system will dominate individually, but how these systems interact. CBDCs, stablecoins, and tokenized assets will only reach their full potential if they can work together seamlessly. Interoperability is key. A tokenized asset should be bought or sold using either a CBDC or stablecoin. and transactions should settle instantly across networks and borders. Early experiments already show bridges between public and private blockchains, programmable currencies, and cross-chain liquidity solutions. The systems that integrate first, when governments, corporations, and financial institutions cooperate rather than compete in isolation, will define the dominant financial landscape of the 2030s. Those who understand integration today will be the ones fully prepared to operate in the new on-chain economy tomorrow. Which one will actually dominate? The future is unlikely to be dominated by a single system. Instead, different tools will dominate different roles. CBDCs will likely dominate government-controlled environments such as welfare distribution, tax collection, and domestic settlements. Stablecoins will dominate open blockchain ecosystems, cross-border payments, and decentralized finance. Tokenized assets will dominate capital markets, investment products, and financial infrastructure. What this means for individuals. For individuals, the most important skill is not picking a winner. It is understanding how these systems interact, learning how wallets work, how digital assets represent value, and how ownership is recorded on-chain will matter more than the specific currency being used. The cost of waiting. Every financial transition creates two groups: early learners and late adopters. Late adopters usually enter when systems are mature, regulated, and widely accepted, but also when the easiest advantages are gone. They pay higher costs, face steeper learning curves, and depend more on intermediaries. CBDCs, stablecoins, and tokenized assets are not fighting for the same future. They are building different pieces of it. Governments want control, markets want efficiency, and users want access. The future financial system will reflect all three pressures at once, but it will also require interoperability and seamless integration. The question is not which one will dominate the future. The question is whether you will understand the system when it does.